One of the biggest challenges that you have was you couldn't use your Visa card or your whatever card you had to buy crypto on these exchanges. And these cards were generally not accepted, or it was just difficult to buy crypto on regular exchanges. And these currencies were volatile. And then, so essentially, that's how stablecoins came about, which is essentially you have a digital currency that is pegged one on one with a regular digital currency that allows you to access the same economic opportunities as having using traditional financial services.
Hey, welcome to the Fintech Frontlines by Cora. This podcast is a collection of timeless ideas on how to build, launch, and operate a fintech in Africa from the most experienced minds in African fintech.
In this episode, Eric Wainana, General Manager Africa at Conduit, shares his insights into the growth and adoption of stablecoins in the remittance and fintech spaces across the world.
I can start by setting a baseline about why stablecoins existed, right? So if you're early in crypto, such as some of us degenerate gamblers, because there was all degenerate gambling. And one of the biggest challenges that you have was you couldn't use your Visa card or your whatever card you had to buy crypto on these exchanges. And these cards were generally not accepted, or it was just difficult to buy crypto on regular exchanges. And these currencies were volatile. And then, so essentially, that's how stablecoins came about, which is essentially you have a digital currency that is pegged one on one with a regular digital currency that allows you to access the same economic opportunities as having using traditional financial services. Now, then that tech essentially did well, and especially was very, very useful on some of these exchanges where the price of ETH or the price of Bitcoin in those days would essentially just move, was very, very sporadic. Now, the same circumstances that exist in crypto, particularly the volatility and of some of those digital assets, is the same circumstances that exist in some emerging market currencies, where some will fluctuate 69% today, others will go up 70%. Like, there are a lot of instability around it. Now, the one thing that has became to the fore is if those same circumstances exist in those areas in that digital world, then imagine what that just means to a citizen in an emerging market economy and their savings, or a business in emerging market economy that needs to buy machinery in local, I mean, in hard code currencies, in Nigerian currency. And so stablecoin have existed to solve that problem, right? In two ways. One, solving the savings problem such that if you want to maintain a balance in, if I want to mitigate against my currency being deflationary, then I can be able to save in a digital dollar and experience the same economic circumstances as anyone else. And number two, and much more critically, if I am a business in emerging markets and I need to pay for goods and services, for instance, in China or anywhere else in the world, that I don't have to, and I'm holding local fiat, that is again also inflationary, that I don't have to go through the same circumstances. So, sort of like just giving a premise, like you asked, of how this industry came about and what's happening now. On the questions of if stablecoins are the future of cross-border payments and remittance, I would say stablecoins have several advantages over traditional fiat currencies. One, they're cheap, relatively cheap, essentially. Recently did the math on a question with someone who asked me how much would it cost sending the equivalent of $1,000 from Nigeria into Ghana. The cost is between 25 and $80. On stablecoins, it's between 5 and 10, depending on which modality you're going to use. Are you going to use a P2P exchange, et cetera, et cetera? So, there's the cost perspective. Second of all, is they're really, really cheap. So a lot of folks will conflate this question and say that stablecoins are here to replace Swift. I don't think we can replace Swift. Swift works very, very well. But what stablecoin truly eliminates is a correspondent bank infrastructure that essentially leads to high fees and slow paced movement of value, because stablecoins allow for really, really quick movement of value between across boundaries and across countries and across jurisdictions. and at the fraction of the cost. And so when you look at what that means from an economic perspective, again, going to Grace's point about economics, from an economic perspective, if I am a SME in Kenya that is looking to purchase goods in China and I don't have to deal with a T+7 transaction, then it allows me to essentially do more. My goods can land faster. The counterparty on the other end can be able to confirm and indeed attest that they've received the funds. And then they can begin shipping whatever machinery or whatever goods or services I'm buying, bring it down to remittance as well. If I don't know if Grace has had this experience of moving funds from your PayPal account, for instance, into your M-Pesa mobile money wallet. The cost of that transaction alone is prohibitive. The speed and it could, in some circumstances, take 3 days. I possibly wanted to go out to dinner tonight. So why do I have to? Do I have to wait 3 days to go to dinner? Essentially, if I'm using the example of the PayPal transaction, and so the speed with which those funds hit whatever account I want, whether it's my mobile money or my bank account, is really, really quick. And so to me, it's a no-brainer that stablecoins are going to be the future of what cross-border payments end up looking like and what remittance end up looking like.
Thank you for listening to this episode of FinTech Frontlines. For businesses that want to build in Africa, Cora provides you with delightful payment products for collections, payouts, and settlements. Learn more at corahq.com. Like and rate this podcast so more people like you can find it.